Hello and welcome to another Wealth of Advice market update on the 3rd of September 2021. Hope you all enjoyed the update last time, which was delivered by Mike and Matthew. Obviously I've been away, I've had quite a few things on in these last few weeks. I've moved house, I've been to a family wedding in Santorini, which was lovely, even with all the sort of travel hassle that you encounter now going abroad, filling forms in, passenger locator forms, getting multiple COVID tests going out and then coming back. It was definitely enjoyable. So in this update, one of the main things we want to talk about is what's going on in the world in respect of the geopolitical risk. Obviously we've seen what's been going on in Afghanistan. How will that affect things in the long term, if any at all, with regards the investments that you have? COVID cases are spiking massively across certain parts of the US. How's that going to affect their output? Will that affect world markets? So as always, we hope you find this update informative and interesting. So as ever with these updates, we'd like to start with some positive market news. The stock markets around the world continue to perform well, albeit a little bit up, a little bit down, nothing really sort of surging ahead. But the US S&P stock market has now risen for 7 consecutive months. That's definitely a positive. UK GDP has grown by 4.8% from April to June. That is a huge increase. Again, why is that happening? Because we emerged from lockdown. Everyone is going out, spending money, trying to enjoy their lives again as much as they possibly can. And this meant that the UK economy grew faster than the US and European countries. Which again, in the past when we've done these updates, we've kind of said we've needed the UK to grow faster, and you should see UK market returns deliver this year. And when we are doing client reviews with our clients at the moment, and we're looking at 12 months returns, we are seeing that the UK funds are now beating the US funds, where again, you go back 6-12 months ago, that was completely the other way around. So it's all good. So the UK GDP is now definitely on course to surpass the pre-pandemic levels by the end of 2021. So this greatest recession we saw in history in the last 100 years, the massive collapse that happened, we're kind of well and truly over that, and by the end of the year our economy will have grown back to be bigger than where it was beforehand. But as usual, we need to point out that there are still risks ahead in this market. Across in the US, their unemployment rate is coming down. It was 14.8% in April 2020 at the worst of the pandemic. It's down to 5.4% at the end of July. Still some way off the lows of 3.5% that we had pre-pandemic. So the US, like many countries around the world, their main bank during the pandemic was pumping money into the financial system to support the markets. They were doing that through a process of buying bonds. That bonds release cash, that cash goes into the market, markets rise. Well, they've announced that they're going to start reducing this stimulus over the next few months. The last time they did that was in 2018 when they pulled money out over a 3-month period leading up to Christmas 2018, and the markets didn't like that, and US markets fell. So we need to keep an eye on what's happening with that. And they announced that as things improve, this is why they are going to reduce this stimulus. So they've got a very tight balancing act to have there. So unemployment's coming down, as we said there, that's good. We need to see the US consumer out spending money again. And they've indicated that they won't increase interest rates until everything does look rosy in the garden again. However, with the US, the thing that we have to be worried about is that COVID-19 cases continue to rise. You can see from these graphs here in the US trends, the number of reported cases by day is spiking right the way up, and the number of deaths by day, unfortunately, is also increasing, which is not a good thing to see. So really, we need to see more people in the US continuing to take the vaccine, and hopefully those numbers come down, because it is quite scary how much it has spiked. And when we talk about like the worst of the pandemic, there's certain states now are reporting their hospitals and number of people in there with COVID is higher than what it was at some of the worst parts of it. So across in Afghanistan, with what's going on there, you can clearly see this is a geopolitical risk. What's going to happen as a result of the fallout and the aftermath of what's happened there. I don't think necessarily in the short term it's going to affect markets. Yes, if it led to terrorist attacks around the world, that might have a negative impact on markets, but markets have been quite resilient to that over the last 20 years. It's been 20 years since 9/11. Obviously the day after 9/11, markets collapsed massively. The day after, safeguards were put in place after that. If a stock market starts falling following a terrorist event, the markets just get turned off. So I don't think there should be anything huge to worry about there. Markets haven't reacted at this time. No fund management groups we spoke to have expressed any worries. But obviously, as ever, we'll keep an eye on things. Across in China, some government policies that we've seen there, which have raised a few eyebrows, which is making things a lot stricter against big technology companies. Education and gaming sectors are going to be affected by that. And one example is that the private tutoring industry, which is worth more than $100 billion a year there, is now going to be changed so that it can be a non-profit making situation only. The Chinese over the last 30-40 years have embraced various areas of capitalism quite a lot, considering they're supposed to be a communist country. So for them now to come out and look at a particular sector that's making $100 billion a year and say this has to be non-profit going forward certainly raises a few eyebrows. We don't have any clients' money directly allocated to Chinese funds, so it shouldn't really affect our investments, these sort of things we're mentioning now. But you have to wonder what other fund managers are going to do as a result, which stocks might be affected. One other area which may affect sort of European companies and US companies is the fact that they've now put a ban, for example, on children playing on computer games for more than 3 hours a week. So some of these huge computer gaming companies which would have been selling their products across into China, that's now effectively being banned, as I say, for more than 3 hours a week. They can only play them on a weekend. I think a lot of people watching this with children and grandchildren might think that's not such a bad idea. It's all kids seem to do now. But it just showing you that this huge communist institution, which had embraced capitalism, isn't quite as fully capitalist as the rest of the world. So this has had some effect on Chinese stock markets in the short term, but you wouldn't suggest it's going to affect global returns in the long run. We now come to that section of the update where we look at how markets have performed around the world over the last few years. The first graph that you can see now shows how the FTSE 100, which on lots of previous updates that we showed you, is now catching up nicely against some of the big indices. And if you look at the FTSE 100 over the last 12 months, it's generated over 23% growth. You compare that with the US market, which is 27%, and the MSCI World Index, which is around about 26%. Stretch that out over a longer period, so we now go back to 2018. 2016. This is a 5-year performance, and you can still see the effect of those 3 or 4 years of uncertainty about what was going to happen with Brexit. How the UK market was pretty much zero growth really, and the only growth that was coming out of the UK market was from the dividends that companies were producing. So no real capital growth in the stock market, as you can see there with the US S&P index and the MSCI World Index. So it's good to see that we are now catching up. Hopefully that means that the UK is still a cheap market for investors to buy into. And I think we are now starting to see a lot more sort of mergers and acquisitions starting to come through, a lot more private equity companies looking to buy out certain companies on stock markets, which can only be good in the short term for sort of returns to get us back to the levels we want to get at. This chart, as you've seen several times over the last 18 months, is the VIX volatility chart. As you can see, again, go back to March 2020 when it spiked to an absolute huge percentage there when risk was at its highest. Risk has gradually come down over the next 12, 18 months, and we're now at a level where we're just bobbing along at pre-pandemic risk levels, kind of normal market risk levels. It certainly feels that way as an advisor. As I say, I've done this job now scarily for almost 20 years. And as I say, it certainly doesn't feel like we're in an environment where we should be fearful of risk, where we were 12, 18 months ago, as I said. So I mentioned earlier in the presentation about what was happening in the US at the end of 2018 when the Federal Reserve started to pull back the stimulus packages at that time. We've got 3 graphs here. Graph A shows the performance of a particular basket of investment funds that we recommend over a 12-month period from September to September. Graph B is September to September another year, and Graph C is September a third year. So this is looking back over the last 3 years. When you look at these graphs, you can clearly see that there's 2 of them that has some rather marked down periods. You should be able to guess that Graph B is COVID, and COVID, obviously everything fell off a cliff but then recovered. Graph A, interestingly, is 2018, and as I say, 2018 from a lot of our clients' point of view was a terrible year. You never made any investment returns for a lot of period depending on when people were invested and when you were looking at, because you can see there markets from the September 2018 fell all the way down to Christmas Eve. After Christmas Eve, Trump stopped arguing with China as much. Trade war was believing to be lessening. The Federal Reserve started buying its bonds again, and the markets recovered and went up nicely. Graph C is September of last year to now. It looks perfect. If I could give that graph to every client every year going forward, it would be fantastic times. The level of growth that we've seen over the last 12 months has been great. Clearly, we were starting on the back of after a collapse. But if anyone was to ask what's the best year that you've had of investment returns, and you were to say from 2020 to 2021, in the future, if you'd ask this question, you'd probably think we were mad. But markets have gone up nicely. We're in a good position right now. And I'm hopeful, as I say, without any crazy silliness around the world from a geopolitical standpoint, and also from what's going on with COVID. If we don't have any huge outbreaks in the UK, in Europe, that sort of thing, then we should see markets continue to rise. So as we enter the final phase of 2021, I am hopeful that markets will do well. So thanks again for listening to another Wealth of Advice market update. We'll be back in touch in a few weeks' time with another update. If you have any questions, queries, please don't hesitate to get in touch.
This material is provided for general information available from sources generally available to the public and is not a personal recommendation. As always, past performance is no guide for future returns. The value of your investments can go down as well as up, so you could get back less than you invest.